If you look at where investors have put their money, it seems like Canada's all-equity ETF decision has already been made. It's VEQT or XEQT. ZEQT rarely gets much love. So why is that? Is there something materially different about ZEQT that explains the gap in assets? Or are these ETFs more similar than most investors assume? Let's take a closer look. In this video, we'll walk through performance, structure, diversification, tax efficiency, and fees, and see whether there's a clear reason investors favor the other two. The obvious place to start is performance. ZEQT launched in January 2022, so we now have 4 full years of returns through January 31st, 2026. And over that period, ZEQT returned 13.4%, XEQT returned 13.36%, and VEQT returned 13.27%. Standard deviation was also slightly lower for ZEQT. Now, 4 years isn't enough time to draw big conclusions, but here's what stands out. ZEQT has about $527 million in assets. VEQT and XEQT have over $11 and $13 billion, which means performance alone doesn't explain the gap. So let's look at structure next. Let's start with the Canadian versus foreign split. ZEQT targets 25% Canadian equity and 75% foreign equity, rebalancing back to those weights over time. That's identical to XEQT. And VEQT is slightly heavier in Canada at 30%. Historically, though, that difference hasn't meaningfully changed long-term results. I suppose if you're investing in a corporation, VEQT's slightly higher Canadian dividend exposure could be marginally more tax efficient. But for most investors, this probably isn't the deciding factor. So if it's not performance and it's not the Canadian weight, maybe the answer lies in how the foreign portion is built. This is where things get more nuanced. I initially assumed ZEQT used fixed regional weights within its foreign allocation, similar to XEQT, but it doesn't. ZEQT's foreign equity weights follow global market capitalization. The US, international, and emerging market allocations adjust naturally as markets evolve. If US stocks grow faster, their weight rises. And if emerging markets outperform, their weight increases. So there's no need for a manager to revisit regional targets. Structurally, that's a very clean implementation of passive investing and similar to how VEQT is managed. So ZEQT doesn't appear weaker here either. If anything, it's quietly elegant. Which brings us to diversification. And this is usually where investors assume there must be a meaningful difference. If ZEQT is missing something, this is where we'd expect to find it. Let's take a closer look. With diversification, there are really 2 critiques. First, ZEQT's US exposure includes fewer stocks than the broader indexes used by VEQT and XEQT. And second, its international and emerging markets ETFs exclude small cap stocks. Starting with the US, ZEQT combines ZSP, which tracks the S&P 500 index, ZMID, which tracks the S&P Mid-Cap 400 index, and ZSML, which tracks the S&P Small Cap 600 index. Together, they form the S&P Composite 1500, which is about 1,500 companies. VEQT and XEQT track broader total market indexes that include additional companies and microcap exposure. So yes, ZEQT technically holds fewer US stocks, but when we calculate the effective number of stocks, adjusting for concentration, the difference is minimal. From a practical diversification standpoint, that's extremely close. Historically, the S&P Composite 1500 and the CRSP US Total Market Index have also delivered nearly identical returns and volatility. Now, internationally and in emerging markets, ZEQT excludes small cap stocks entirely. But if added, they'd represent less than 4% of the total portfolio. And over the past 20 years, including them hasn't meaningfully changed long-term results. Still, from a completeness perspective, I'd personally welcome their inclusion. But again, once quantified, the diversification differences are subtle. Structurally, ZEQT is well designed. Its international and emerging markets ETFs hold the underlying stocks directly. XEQT is structured the same way. VEQT still uses Vanguard's US-listed emerging markets ETF, which introduces an additional layer of foreign withholding tax. Emerging markets are the smallest allocation in all 3 ETFs, so the impact isn't dramatic. but ZEQT and XEQT do have just a slight edge here. ZEQT charges 0.15%, while VEQT and XEQT charge 0.17%. Now, 2 basis points won't change anyone's retirement plan, but lower costs are still a positive. So once you put everything together, performance, structure, diversification, tax efficiency, and fees, here's how it stacks up. Performance, essentially a tie. Asset mix, very similar. Diversification, slight differences, but modest in practice. Tax structure, slight edge to ZEQT and XEQT, and fees, slight edge to ZEQT. These ETFs are far more similar than they are different. ZEQT isn't clearly superior, but it's also not clearly inferior. And given how small the structural differences are, the popularity gap may say more about investor behavior than anything fundamentally different in the portfolios themselves. If you're invested in one of these all-equity ETFs, I'd genuinely be curious what drove your decision. Feel free to leave your comments below. In my next video, I'll look at the long-term back-tested performance of the BMO, Vanguard, and iShares asset allocation ETFs, so please subscribe if you'd like to learn more. Thanks again for watching, and I'll see you soon.